I'm Dawson Schmidt here with the latest stories and developments in this week's Commodity Roundup on Trader PhD. Nearby corn futures hit a milestone this week after finally trading at $5 a bushel for the first time in more than a year. The March contract fell short of the level by just a quarter cent last week. However, prices traded as high as $5.04 on Tuesday. A tightening U.S. and global balance sheet helped drive prices higher since late summer. U.S. corn ending stocks are projected to fall during the 2024 and 25 marketing year after 3 years of increases. Demand chewing through supplies this season is expected to drive the stocks-to-use ratio to 10.2%, the lowest since 2022 and 23. Strong ethanol production and whole corn exports have been a primary driver of the lower corn carryout estimates. This month, the USDA's WASDE report left the corn balance sheet unchanged at 1.54 billion bushels. Bullish sentiment drove speculators to the largest net long position since April 2022, only 40,000 contracts below the record long of 402,000. However, traders reduced their net longs last week after March prices traded just below $5 a bushel. Limited rainfall in Brazil is allowing for more field work as farmers harvest soybeans and plant corn. Brazilian consultancy firm AgRule reported that 23% of the soybean crop was harvested as of last week. Progress sped up but remained behind last year's pace of 32%. Half of Mato Grosso's harvest is completed and is sitting just 3 percentage points behind the 5-year average. For the winter corn crop planted behind soybeans, 36% of that has been sown. That compared to 59% seen the same week last year. Progress lagged in Mato Grosso compared to a year ago, though planting is also catching up to the 5-year average. Private forecasters expect below normal rainfall in Brazilian state over the next 10 days. Limited precipitation should give farmers an opportunity to increase field work. Meanwhile, chances of above normal rainfall in Argentina could benefit crops ahead of filling stages. The market is looking past the USDA's annual cattle inventory report released last month and is now focusing back on the monthly data. The agency will release its February cattle on feed report this Friday. Ahead of that report, a Bloomberg survey of analyst estimates expect the February 1 feedlot inventory to total 11.7 million head, down nearly 1% from a year ago. Last month's report showed the percentage of heifers in feedlots was nearly 39%, falling just slightly from the previous quarter. The USDA won't provide another breakdown of heifers and steers until the April report. Placements are expected to have increased by 2.7% from last year to 1.84 million head. The resumption of feeder cattle imports from Mexico could help placements recover after falling to the lowest December print since 2015. Fed cattle marketings for January are expected to have totaled 1.88 million head, up 2.1% from a year ago. If realized, that would be the strongest January print since 2019. Be sure to be on the lookout for analysis of that report after its release. Thanks for listening. I'm Dawson Schmidt, and this has been Trader PhD.